Hello, everyone. So today we are here together. I'm with Dwayne Graham of New American Funding. How are you doing, Dwayne?
Good. How are you, Gwen?
Great. So today we're going to talk a little bit about, I've been getting some questions about what do people need to do when they are first starting to take the process and do the process of buying a home. And so I wanted to give them some information about talking about the credit scores, student loans, debt to income ratios, and how all of that affects their ability to be able to purchase a home.
Mhm.
So, can you tell us about the credit scores? How does this credit scores really affect? Why are the credit scores so important?
Yes. Okay. So credit is one of the most important things because it's heavily weighed when it comes to determining if somebody's approved and how much they're approved for. So minimum credit score that's needed in order for an approval is different depending on the loan program. So an example, for a FHA loan, minimum credit score that we require is a 580. For VA loan, minimum credit score that we require is 580. For a conventional loan, the minimum credit score that we require is 620. So depending on the loan program, each loan program is going to have a different criteria when it comes to the minimum required credit score for the different programs. Now, one very important thing, just because you have that credit score doesn't mean that you're automatically approved.
Okay.
That's just the minimum that's required in order to run the information through the automated system to see if you're approved. But credit is important. It does play a vital role in determining if you're approved and how much you're approved for.
Okay, that's great because I know a lot of people say, well, I have a 580, but I'm still not being able to get approved. So that doesn't guarantee an approval.
Oh, no, I wish it did, but no. So that's the minimum credit score that's needed in order for the approval. Now, it's not just the score that matters. The entire credit profile matters. So just as an example, somebody who has they're taking a look at going FHA and they have a 600 credit score, but life happens. They went through a rough patch. They fell behind on a couple of payments. So they have multiple late payments that are recent. Whenever that person is ran through the system, it might not approve them, even though they have a credit score that's above the 580.
Okay,
Yeah.
okay,
It's not necessarily the credit score, it's the credit profile, but the credit score has to be at a minimum number.
okay. And
Yeah.
then also, I know a lot of people say, well, I looked on Credit Karma, and Credit Karma
Yeah.
said that I had a 680 credit score. So why are you saying that I have a 580?
Yeah.
Can you kind of explain that to them?
Sure. So the score that shows up on the consumer side is 99% of the time different from what we see as a lender because the scoring model that's used. So for Credit Karma, for credit.com, for anything on the consumer side, I've seen it where it's 100 points higher or 100 points lower versus what we see as a lender. So it's not necessarily that that's your credit score. It gives you an idea of where your credit scores are, but it's not 100%, yeah, that's what the lender sees. Um, Again, anything on the consumer side, 99% of the time, it's completely different from what we see as a lender. So even though Credit Karma might say 700, when we pull it, it might not be the 700. Yeah.
Okay, because y'all don't use the same system to pull credit. Mortgage, when you're dealing with a mortgage, is from a different system, right?
It's a different scoring model.
That's different. Okay,
Yeah.
okay, good. So let's talk about some student loans because I've dealt with probably about 75% of people that I talk to say they have some student loans and, confused about how student loans really work when getting a mortgage. So can we explain to them how the student loan will affect their ability to be able to get a qualified or approved?
Yeah, so the student loans, depending on the loan program, there are different criteria that are applied for student loans, even if the person's not making a monthly payment. So just as an example, on a FHA loan, if somebody has student loans and the balance is $40,000, but the student loan is deferred, even though that person's not making a payment, a portion of it is still taken into account when calculating debt to income ratio. So on an FHA loan, if the person is not making a payment, it is 1% of whatever the balance is on the student loan. So if they owed $40,000, $400 per month would be counted even if they're not making payments. Now, for conventional, it's a little bit different. If conventional, if it shows a zero payment, and say the person's on an income-based repayment program and they're not required to make a payment. If we can get documentation that says that they're not required to make a payment and the payment is zero, we can actually qualify them with zero, even if it shows like 40,000.
Okay, and that's on the conventional loan.
Yes, that's on a conventional. It's a little bit different when it comes to the different loan programs, but with FHA, it's 1% of the balance whenever there isn't a monthly payment that shows up. If a monthly payment does show up, it's 1% of the balance or whatever the monthly payment is, whichever one is greater.
Okay. Okay.
Yeah. And
but
that's not,
go ahead.
That's not a lender requirement. That's FHA's requirement, and it'd be the same regardless of the lender that they talk to.
Okay. Okay. So, but that payment, the student loan, it has to be either deferred or in another type of program. It can't be in default.
Very, very good point. Yes. So if the student loan is in default, it has to be brought out of default. And typically, if it's in default right now, the student loan company or the Department of Education, they're going to want a set amount of months to be paid before they'll bring it out of default. So just as an example, say it's in default right now, and the client calls the Department of Education and they say, we'll work with you, we'll set you up on a payment plan, I'll accept $50 a month. They might say you have to pay $50 a month for 5 months, for 6 months, for whatever it is that they say in order to bring it out of default, and the client wouldn't be able to close on the loan, or they wouldn't be able to get approved until it comes out of default. Yeah, okay. Very, very important. Yeah, okay. But that only applies to FHA. If it's conventional, even if it's in default and we get the approval through the system, if the system approves it with it being in default, then the client's fine.
Okay, so it really does depend on what type of loan you have or you're getting approved for.
Yes.
Okay. Okay, great. So also we talk a lot about debt to income ratio and trying to explain to people how that works. What does debt to income really mean when it comes down to getting approval, and then how does it affect the approval?
Sure. So debt to income ratio is very, very important. What the debt to income ratio is, it's how much the person takes in per month versus how much they put out per month for the minimum monthly payment for everything that shows up on the credit report, plus the projected monthly payment on the house. So an example of this, say for instance, they make $5,000 a month gross, and all lenders use a gross amount. So say for instance, they make $5,000 a month gross, and their monthly debt, so that's car payment, student loan, credit cards, everything comes up to $1,000. And the payment on the house with principal and interest, taxes, insurance, mortgage insurance, everything comes up to $1,500. So their debts are $1,000. The projected monthly payment on the house is $1,500. So their total monthly obligation is $2,500. If their income is $5,000, $2,500 of their income is used towards debt. So that would be considered 50% debt to income ratio. So half of their income goes towards their monthly debt obligations. So that's how the debt to income ratio is calculated. The debt to income ratio maximum is based on the loan program. So another example, for conventional, we've seen approvals up to 50% debt to income ratio. For FHA, we've seen approvals up to 57% debt to income ratio. For a VA loan, we've seen approvals for up to like 72% debt to income ratio. So it depends on what the system approves and what the actual debt to income ratio is.
Okay, okay, that's good to know because a lot of people don't understand what that really actually means and why it is that they can't get the approval if they have the income coming in, but then also understanding the amount of things that they're paying out also affects it.
Yes, and it's the minimum monthly payment for everything. So if the person has a credit card and the minimum monthly payment is $100, but they pay $200 or $300 a month, we don't use the $200 or $300, we use the $100. So the minimum monthly payment for everything that shows up.
Okay. Now, let me ask, how important is it to know your what your debts are?
Yeah.
When you get to really kind of asking those questions of what do you owe, a lot of times I hear people say, "Well, I got this and I got that," and then when you run the credit, it's they got 10 other things. So when you when you're getting approved for a loan, how
Mhm.
important a mortgage, how
Yeah.
important is it to really know what you're paying for?
So it's very, very important. It's advised that they try to get an idea of what their minimum monthly payments are, so that at least they'll have an idea of what the loan officer looks at when he tries to qualify them. I talk to clients all the time, and same example. Say, for instance, the person's their monthly obligations are 1,000. The projected monthly payment on the house is 1,500, but they only make $4,000 a month. That's 2,500 versus $2,500 in monthly obligation versus $4,000 in income. There's $1,500 that's left over. And the question that I get asked a lot is, why can't I get approved for more because I have $1,500 left over? Um, the amount that we qualify for is based on the gross amount. It's not the take home. So even though $1,500 is left over after the gross, there isn't that much that's left over when you consider the take home amount. And each lender has set standards that they have in place whenever it comes to calculating debt to income ratio and the max that they'll go up to. And it's just, there's set standards that every lender has. Some lenders are a little bit more aggressive, like us. We go higher than most lenders, but some lenders are a lot more strict when it comes to the max debt to income ratio that they'll allow.
Okay. Okay. So that's good information to know. Um, let me ask that since the virus is going on now, how is the
Mhm.
virus affecting getting approved for a mortgage? Or
So
is there an effect?
well, so yes, it has had some impact. Um, Things with us are starting to loosen a little bit. Perfect example, when the virus just happened a few weeks after that, um, it had a huge impact on every lender in the country. So things got more strict for every lender. We went from a 580 credit score to a 620 credit score, but since things have kind of settled down, things have kind of calmed down, we're going back now to the 580 credit score. We're one of the only lenders that I think offers down to the 580 credit score when it comes to approval. But some lenders are still holding on to the higher credit criteria requirement, but we've relaxed on it a little
Okay. Okay. That's good to know. And so, is it a good time to buy?
bit. Absolutely, yes, it's a great time to buy. Rates are still low. Rates are the lowest that I've seen. I've been doing mortgages for 15 years, and rates are the lowest that I've seen it ever. So it's
Wow.
still a great time to buy. And the thing is, there are a lot of buyers out there right now who are buying, even though you would think that it would have slowed down. No, it's pretty busy right now because, again, people want to be in their homes. They want to be in their homes quickly, and they want to be in their homes so that they can get settled in before school starts. So is it a great time to buy? Absolutely. Rates are low. Um, there's still inventory out there. If you see, if you have a client, or if any clients are out there and they're searching, they see something they like, I highly recommend that they jump on it right away, because there are probably 4 or 5 other people who have seen the
Yeah.
exact same house that they're thinking about making an offer on, who are getting ready to make their offer.
Right. Right. Well, that's good to know. So, what kind of advice would you give people as far as, especially like first-time home buyers who haven't been through the process and really don't know where to start? What advice would you give them concerning trying to get approved?
Mhm. So best advice I can give them is talk to a lender as soon as possible. Even if it's something that they're not ready right now, they can still talk to a loan officer to get an idea of what they could do right now if they wanted to. They don't necessarily have to do it, but it gives them an idea of what they can do. Doing that opens up the door for a couple of things. If there's anything that they need to work on, they have time to work on it right now instead of waiting until the last minute and then trying to start. So if they're in a lease right now, the lease isn't up until November. If they take a look at things right now, they'll get an answer of yes, you're approved, you can get stuff done right now, so that when it comes closer to November, they won't have any issues. If there are issues that they need to work on right now, then they have time to work on it, and they're not rushing if they waited until close to the November timeframe. So best advice, if they're thinking about purchasing, reach out to a loan officer, get their questions, their concerns addressed, get the process going so that they have an idea of how much they qualify for, what their monthly payment would be, what their down payment would be, what their cash to close would be. They at least get an idea of what they can do right now if they want to. And again, even if they don't want to right now, they know, they have the peace of mind of knowing that they can when they're ready.
Okay, thank you so much. I appreciate it. So, you know, if y'all have any questions about getting approved for a mortgage, you can always reach out to Dwayne. Dwayne, can you tell them how they can contact you?
Sure, absolutely. So my cell number is 832-661-9060. Again, 832-661-9060. Or they can reach me by email. Email is dwayne.graham@nafinc.com. That's DWAYNE.GRAHAM@NAFINC.com.
Okay. And if you have any real estate questions, you can always reach out to me, your intentional agent, Gwen Ransom at Remax Professionals at 346-702-6748. We do these videos so that we can give you some information, give you a little education about what's going on and how to get pre-approved for a home and become a homeowner. So there's still plenty of time. If you are thinking about becoming a homeowner, now is the time to get started so that we can be able to come up with a plan for you to become a homeowner in 2020. So if you are looking at this video, we would like for you to like it and share it and comment. If you have any questions, you can comment on the video or you can reach out to either one of us. We will be able and willing to help you in any way that we can. So thank you for watching, and until next time, we will see y'all later. Bye.
Bye, guys.